Hi everyone, welcome to our DAT IQ weekly market update. This is our update for June 18. This is episode 296. I'm Dean Croak, market analyst here at DAT Freight and Analytics, along with co-host Chad Kennedy, who's sitting in for Ken Adamo, and special guest John McCowan, friend of the show. Welcome back, John.
Thank you. Pleased to be here, Dean.
Yeah, good to have you with us. John, for those that haven't seen the show before, tell us a bit about yourself and some of your history in the container business.
I've been in the container space really for 4 decades. Most of that as CEO of a company that I co-founded, and more recently, I write a lot about the sector. My mentor for 20 years was Malcolm McLean, the gentleman who invented container shipping way back when. So container shipping has really been my total career focus.
Yeah, if anybody that's read the book, The Box, you'll understand the history and where it came from. It's a fascinating read. I'd highly encourage everybody to do that. Great to have you with us, John. Chad, you're got an interesting career background also. Tell us a bit about yourself.
Yeah, so I'm approaching the 20-year mark in supply chain. I started out with a small trucking company in Lakeland, Florida, married into a trucking family. So yeah, cut my teeth on dispatching truck drivers, customer service, that sort of thing. And then moved over to the shipping side. So I was with a large shipper for about 9 years. We moved about 1 million loads a year, mostly US, Canada, Mexico, but there was a little bit of ocean there. So John, looking forward to learning a lot from you about that. But yeah, I've been with DAT on the product side of the business for the last 6 years. And it's been great. So happy to be here.
Well, good to have you with us. We've got a lot of experience here on the show. So let's get into our market update. Remember, if you've got questions, drop them into the chat section and we'll get to those during the show. So let's start with some of the key trends we're watching this week. Carrier spot rates. These are broker to carrier spot rates, flat last week. The spread is sort of sitting around 37 cents per mile between line haul contract and spot. It is gradually narrowing, but Chad's going to cover that a little bit later. When you look at the outbound line haul rates in the top 5 states, that's Georgia, California, Texas, Illinois, New Jersey, they account for about a third of our national volume. They were sitting at about $1.85 a mile last week. It's about 2 cents a mile lower than where they were last year on a 2% lower volume. Also identical, though, to where they were in 2019 as a point of reference. Active contract rates, Chad's going to get to this a bit later in his section, down uniformly negative about 1 to 2%. Replacement rates based on recent RFPs also negative 1 to 2, but much closer to parity than the last report. May imports up 3% month over month and 7% year over year. Ahead of possible Gulf and East Coast labor action. We'll bring John back a little bit later to talk about what we're seeing there. The Journal of Commerce index that Ari Ash puts out continues to show that shippers have pricing leverage when it comes to intermodal or truckload. The average shipper using intermodal is saving around 25 to 27% across the US using contract intermodal rates compared to contract truckload. Jason Miller's truckload ton mile index down 1% month over month in April. He also says there's zero evidence of a sustained increase in trucking freight demand. And to quote him, volumes continue to bounce along a trough. Hurricane season is already underway. It's just 2 weeks old. We've got some pretty big weather systems starting already in the Gulf this week and off the Florida coast. This is kind of a harbinger for what we can expect during the Atlanta hurricane season. Florida was deluged with rain in the last week, flooding rains 2 feet deep in some places. So yeah, lots to watch as we head into this week, and including the heat dome that's sitting over the eastern US. For those that are new to the show, the full version of this week's market update will be available tonight at dat.com/market update. It'll include a detailed discussion about NOAA's Atlantic hurricane season, watermelon season, and the truckload ton mile index. So let's get into our truckload market index on the update on the spot market. Let's start with the load to truck ratio for dry van. Volumes remained within about 4% of last year. Compared to non-pandemic influenced years, 2021 and 2022, when you exclude those back to 2017, last week's average load post volume was about 5% higher. That caused the load to truck ratio to decrease slightly to about 4.34 in refrigerated. The refrigerated load to truck ratio volumes decreased last week ever so slightly, sitting about 2% higher than where they were this time last year, compared to non-pandemic years, sitting about 6% lower. Carrier equipment posts were down last week. The load to truck ratio was up slightly to 6.31 loads per truck. In flatbed, the gains from the surge in flatbed load post volume in the first week of June were erased last week, dropping 14% week over week. Load to truck ratio decreased to about 15.6 loads per truck. Having a look at the year-over-year change in spot rates, the national average dry van line haul rate was mostly flat for the third week, averaging about $1.66 per mile. That excludes fuel, and it's also identical to this time last year, but we're seeing about 6% lower volume of loads moved in week 24 compared to last year. On our top 50 lanes, based on the volume of loads moved, they averaged $2.02 per mile last week, up a penny per mile, and about 36 cents a mile higher than the national average, also about 3 to 4% higher than this time last year on the top 50 lanes. In the refrigerated market, the national average reefer line haul rate has remained flat for the last 3 weeks, averaging 197 as we head into peak produce season. At this level, reefer line haul rates are about 10 cents a mile lower on 9% higher volume of loads moved in week 24 of last year. And lastly, in flatbed, flatbed line haul rates remained flat last week, also sitting around 208. The national average is 6 cents a mile lower than last year on a 9% lower volume of loads moved in week 24. Let's dive into the short-term forecasts. For those new to the show, the blue line is the rolling 7-day weighted moving average. These are actual loads moved. We're forecasting out over 550 miles, excluding fuel, so line haul only. Ratecast is in green. That's our flagship rate product. Red is the short-term model. That heavily weights more recently seen data. And then the yellow and the grey are blends of the two. So dry van, the general consensus with dry van, as you can see up and to the right there, is that all 4 models are in agreement over the next 35 days. Produce season is having an effect on dry van as reefer carriers move from dry van over to the refrigerated market. Ratecast in green is reflecting a stronger seasonal trend. It's looking for a lift of about 7 cents a mile through 720 into almost the third week of July, whereas the short-term model is a little bit more aggressive. It's looking for an 11 cent per mile. Again, as has been the consensus for the last few weeks, I think Ratecast is pretty close to the money looking out 35 days. In refrigerated, produce season isn't delivering the kind of volume we're used to halfway through June. USDA reports truckload volumes are about 6% lower than where they were this time last year. But as a point of reference, they're about 3% higher than 2019. So Ratecast is looking for about a 2 cent per mile lift over the next 35 days, but it's looking for 6 cents a mile lift through July 4, which is when spot rates typically peak in the produce season and then fall away fairly quickly through the end of July. So I think Ratecast again is reflecting where we see the market. And to end with flatbed, we're expecting rates to continue cooling. Most models are in agreement there. In fact, all 4 are in sharp agreement as we head into the middle of July. Most of them are looking for an average of about a 5 cent per mile drop over the next month. Ratecast is about 3 cents per mile between now and July 20. So that's it for the market update, including the forecast. We're going to transition over to Chad to talk a little bit about what he's seeing in the contract freight market.
Yeah, thanks, Dean. So this is a view from our large shippers and how they're procuring and the mix of what they're procuring. So here we have the dry van large shipper procurement mix of contract in blue and spot rates in yellow. Currently an 84% mix of contract rates and 16% mix of spot rates. This is down from 23% March of 2021. We've observed a long-term trend through the troughs of 2016, 2019, and now 2022 to current, that shippers are ratcheting up their spot mix. Shippers tell us this is driven through better technology and strategy to purchase spot rates with index-based pricing and API connections to brokers. So I'd like to point out that this yellow spot mix has traditionally been more live load as opposed to drop trailer moves and long haul moves. So it's somewhat limited in what shippers can shift into this space. The spot shipments here in yellow, for example, have an average distance of 650 miles, while the contract is 439. When most shippers explain their strategy moving freight into spot during the trough in the market, it's always very measured and limited by freight characteristics that are more attractive to brokers. The black trend line here represents our spot premium ratio. This represents the shipper buy from broker or carrier rates and the degree to which those spot rates are above or below contract rates. A spike in this metric is a quick signal of a potential turn in the market cycle. Dry van spot rates remain 9% below active contract rates right now. And the spot premium ratio trend is up since 2022. This is mostly a function of contract rates decreasing and less so of spot rates increasing. And so the general expectation is this will eventually spike at some point, triggered by a demand event, such as extreme weather, like Dean talked about earlier with the hurricane outlook. And that would send spot rates above contract rates. Of course, these events are difficult to predict, but some are looking towards this heated Atlantic Ocean and some that fueling some hurricanes here in the next few years. So onto the reefer mix. So I'll keep the rest of this pretty short. Reefer, we see a slight uptick in spot mix, and spot premium ratio is at 17% and 11% respectively for June to date. So we're a few weeks in and still bouncing around recent all-time lows. And then finally, to round this out with intermodal, intermodal spot mix largely lacking a market cycle. As you can see, it's pretty flat. So it's unlikely we'll continue to report on this metric, but it is interesting that the spot premium ratio does have that market cycle built in, and it peaked in September 2020 and a recent low of 9%, March 2023, and currently bouncing around 6%. So that's a wrap on the shipper procurement mix analysis.
So John, let's bring you back in. Been waiting to ask you this question for a while. May imports were up nationally. I think the peers IHS market data that we look at has month-over-month volumes up about 3%, up about 7% year over year. But Los Angeles was way down compared to past monthly data sets. I have Los Angeles down about 13% month over month. What do you make of this, John?
Well, the May data it hasn't fully come in, but what is amazing is that the first part of this year has been ripping in terms of inbound volume. I kind of track the top 10 ports, and in April it was up close to 13%. That's the third straight month of double-digit increases. I think we were at 19% for March and 27% for February. And so sometimes at the very beginning of the year, you have the Chinese New Year effect, but with those 3 months ending April, pushing kind of trailing 3 months up 18, 19%, it was really eye-opening to me. And we went through obviously kind of a real roller coaster with COVID, and you had to kind of look at the comparisons versus the previous year. But my read is, at least in inbound volume, the last 3 months that I have detail on it, it's an indication of something that's going on. Seems to be underlying economic strength, and at some point, much of that volume turns into domestic loads. But and so we're seeing a cooling off certainly in May. I don't have all of the data. I like to kind of look at the aggregate. But when you kind of balance that against what's been going on, the inbound loads to the U.S., which of course were highly imbalanced, like 2.2 loads for every load going out, revenue load going out. But it's really ripping, and it's quite a story that still needs to be played out, I guess, in terms of what's really going on.
Yeah. How much do you think shippers are moving their discretionary volume away from the East Coast and Gulf Coast because of potential labor action? Is that a factor, do you think? And maybe what we're seeing is a pull forward of inventory earlier in the year. Is that possible?
I don't think you're seeing much of that in the data so far. Certainly, we saw that as a big element when we went through the ILWU. And on top of that, there was bigger congestion on the West Coast, and that led people to change the ports. That's probably the biggest beneficiary of that was Houston, which is kind of the first stop on the Gulf and East Coast if you want to switch that. As it relates to what's going on with the ILA, traditionally the ILA hasn't been as prone to strikes, frankly, as the West Coast. A lot of people are getting concerned. There was an incident where the talks, I guess, recently were called off. I think the contract still goes towards the end of the year, so we're away from that. But it might be premature to see people starting to shift. Roughly, if you look at our containers coming in, 50% go over the West Coast, 50% go over the East and Gulf Coast, and certainly at the margin, you're seeing. If it starts to look like there could actually be a strike, you'll see some shifting there.
Yeah, because that agreement ends in the end of September, but it's also an election year shortly thereafter. So you can see some politics playing out in the labour agreement talks. But how much advance notice do shippers need to change their routings if we get closer to September 30?
Well, that's each supply chain is kind of somewhat unique, but these chains are longer than people think in terms of the transit from Asia to the U.S. To the West Coast is 3 weeks, and it's roughly double that to the East Coast. So certainly you need to have that, but it often it's hard to really kind of turn these maritime supply chains on a dime. It's eminently more difficult than what somebody can do with their domestic supply chains. Because it requires a lot of coordination. So that's just one more headache for traffic managers that are involved in maritime loads.
Yeah.
So, John, does that mean if I'm a shipper and I'm looking out towards October 1st as a potential deadline and strike on the East Coast, might I start shifting some of my routes to the West Coast in August?
I think you could see that. Again, sometimes if enough people start to do that, you kind of create a problem on the other side, and there's often kind of a case to be made for kind of sticking with kind of the known situation. But yeah, it would clearly, as it relates to, Dean hit the nail on the head. If there was any real action in terms of an actual strike, that would be an immediate kind of nationwide economic crisis, if you will. That would, and a lot of people think that the power of the labor unions in terms of the dock workers is almost a little too powerful, because if they actually strike, that's almost requiring, the president to become involved. And that obviously would not be something that any president would like to do, but the consequences of an actual shutdown, there will be problems that will go beyond what we could imagine if you had a coast-wide shutdown. And that's why, again, the history of the ILA has been, it's been quite a long time since there's been an actual strike. And when these labor situations, usually the worse they get, will be kind of selective action at certain places, because again, the consequence of a coast-wide strike would be economically catastrophic. You're talking about the U.S. brings in $9 trillion worth of stuff in containers. Stuff is a technical term, but it's everything that you can imagine. And if that shuts down even for a short period of time, everything along that chain of $9 trillion is impacted. So it's one of those things that seems to be very unlikely to actually happen, in my view.
Yeah,
John,
like that point.
sorry.
Yeah, Sorry, Dean. I like the point that you made about if everybody goes to the West Coast, now you have this self-fulfilling prophecy almost, and you've created a worse problem than maybe you avoided. Yeah.
Yeah.
Well, we've had multiple examples recently. Certainly, starting with COVID itself and the roller coaster everybody went through. I mean, I think the nation's become more educated or more aware, rather, of the tie-in to this maritime supply chain that was largely invisible to people, and we're seeing the impact of unknown events. I mean, for instance, we're starting to see. In addition to that volume in the U.S. coming up, which is putting upward pressure on pricing, the whole worldwide container shipping industry is being impacted by what's going on in the Red Sea. Mm-hmm. And that situation hasn't gone away, hasn't shown any indication of resolving itself. I guess recently with the drone attacks, it's kind of become an additional way of stopping it. And the big factor there is that lane from Asia to Europe represents roughly 25% of worldwide container miles. Mm. And now all of those ships are going the long way around Africa, which is adding roughly 1/3 to the distance. So what is happening just automatically is something on the order of 8% of the worldwide container shipping capacity is being kind of withdrawn. And so that's, and you also have the worldwide data has been quite strong. And one of the months recently, we're looking at a trailing 3-month worldwide container volume up close to 9%. And that's very, very strong. And so you have both things kind of working, I guess, to the advantage of the carriers, to the disadvantage of shippers from a pricing standpoint, with demand going up or above usual and supply going down. Mm. So we kind of the unfortunate thing is that the terrible thing for shippers is that when you have these outside events and things that kind of really turn things upside down, and service becomes worse than ever and more unpredictable, and yet the profits for the carriers tend to go on be quite significant, and that's a very unfortunate combination that only works for the carriers.
Right, John. I was reading a report in the Wall Street Journal. I think Paul Berger wrote the article. He was talking about if there was a Hamas-Israel peace agreement reached, and there's talk about that this week, that somehow the conflict in the Red Sea might dissipate, even go away, and that would result in a crash in spot prices because of the 8% of capacity the exit transit's absorbing. My instinct is that sort of the terrorism aspect of attacking ships along, that part of the world won't go away, even if a peace agreement is reached. Do you ever see people going back to normal and using the Suez Canal?
Well, I think at some point we will go back to using the Suez Canal. I don't think any resolution of the Israeli situation would really have much, if any, effect. One of my colleagues at the Center for Maritime Strategy, Ian Ralby, is a brilliant expert on the Houthis and knows much more about them than I do. But Ian has said, and I think he's quite correct, that the Houthis are just using this as an excuse. They've been, I strongly feel that, this is nothing more than a criminal, situation. And it's unfortunate that the world hasn't figured out a way to deal with that. It'd be nice to see the Chinese perhaps be against this, because nobody's being hurt more in terms of trade than the Chinese. But I don't think that the Israeli, it's being used as an excuse, but I don't think it really has much impact. So we need to find a way to stop criminals and terrorists from taking advantage of choke points, not only in terms of the Red Sea, but in maritime commerce. Sadly, there are many other potential choke points. If you have a group of terrorists that want to, get their name in the paper, we certainly don't want any copycats of what the Houthis are doing.
Yeah. John, your report that comes out, I'm not sure, I think it's the middle of the month, maybe towards the end of the month. Your May report will be out soon, I guess, or is
Yes.
Yeah. So you talk about the top 10 reports, and I'm kind of interested. The McCown report looks at the top 10 reports. How much volume do the top 10 reports represent typically?
They represent about 85% of total inbound containers into the U.S. There are a total of 33 ports in the U.S. that have regular container business, but again, many of them are quite small. There's some big ones outside of the top 10. I think Baltimore, for instance, which was had the situation with the ship that hit the bridge. But Baltimore is, I think, ranked number 12. It's right at about 2.2% of volume. And so while that clearly has an impact or had an impact and will continue to have an impact on local commerce, the port is now open, but that volume didn't really move the needle. That was a fairly easy thing, unlike, what we talked about with the potential coastwide strike. There are ships that would simply drop off cargo that normally would go to Baltimore and Norfolk or perhaps even New York. So yeah, I focus on the top 10, and that's pretty consistent with what all of the ports are doing. One of the things that we have seen and will continue to see, quite frankly, is a move kind of eastward to freight. If you kind of look at, in the end, my own view is containers, or at least the cargo in containers, generally ends up where people are. So it's going to be, correlated pretty strongly with population. And if you just do a simple look at the map of the mainland and kind of look at, distribute all those, something on the order of, 25 million TEUs that come into the US, and just simply use an algorithm in terms of cost per mile of the different modes, you would find that the best distribution would be one where the ship gets relatively close to where it's going. And that, of course, means that, freight that is going to eastern points should go by water to the east or the Gulf Coast. And if you look at that population distribution, again, right now we're still at about 50-50, and yet only about 25% of the population of the mainland could be better served economically over the West Coast. Now, obviously, there are other factors involved. Distribution systems have been set up based on the West Coast. If you go way back when shipping had conferences where they set prices, the pricing was literally set the same, a load going from Asia to New York, either all water, or Asia to New York via double stack crane. Well, that made a pretty simple decision for shippers, because you're getting there 8 or 10 days quicker, and quite frankly, back in those days, it was more predictable when it was intermodal. But so I think you're going to see that shift continue in a subtle way. It's never going to be. We're certainly going to have more than 25% of our inbound containers coming over the West Coast, but I don't think it's going to be 50.
Yeah. It's interesting. I was looking at our line haul rates from Los Angeles to Chicago this morning, because during the pandemic, we saw a tripling of volume on that lane. And of course, that's one of the heavy intermodal lanes, to your point about the economics of moving east of the Mississippi. At the peak of the pandemic, truckload rates on that lane, Los Angeles, Chicago, were $3.14, excluding fuel. Today, they're $1.52. So they're more than half what they were during the peak of the pandemic, but they've been at that level for about a year now. So it makes long distance truckload a fairly cheap alternative if you're landing containers on that West Coast in particular. So John, I like your graph. One of the graphs I read in your McCown report every week is the 3-month trailing average of the change West Coast, East Coast. So there's been a reversion of volumes back to the West Coast. Do you just see that heading back to where it would be normally?
It certainly it's coming back, and some of that was temporary. But I think as I recall that graph, over a 7-year period, the trend line showed it going down about 10%, and so that really predates COVID. One of the things that was a strong positive catalyst for that was the expansion of the Panama Canal, because it used to be Panamax. The canal only allowed a container ship about 4,400 TEU. And so you could bring a much bigger ship to the West Coast, and to move it all on all water, that would be a smaller ship. But with the expansion of the canal, you can now get close to 13,000 TEU. So that's changed the economics. I think the other factor, at some point, there'll probably be some sort of carbon tax on container shipments. That will then kind of quantify, what's already a pretty strong environmental difference, with kind of a cost difference. And I think as the container shipping companies have consistently gotten better on their on-time arrival. When I started in the industry, it was typical, you'd have a voyage where you might call on, 20 ports on both sides. And now it's migrated to much more kind of direct service, and with that, the timing is more consistent. So I think that clearly there will be a speed advantage to moving freight intermodally, which is generally how it goes if it's going across the country. But that has to be balanced against cost, and I'm a big believer in cost flowing in the end, however one defines it. There are all sorts of measures you can throw into cost, but it usually is the best metric to look at.
Yeah. John, while we have you, what's the best way for folks to subscribe to your monthly report?
Just send me an email at john.d.mccowan@gmail.com, and I'll be pleased to put them on the list. I do a monthly report on U.S. container volume that I'm tickled is well read by a lot of folks in Washington, not because policymakers are particularly interested in the container shipping industry, but they're now well aware of its impact on the economy. I also do a quarterly report on the results of the container shipping companies. About 2/3 of the world's container shipping companies are publicly held all in, really, for the most part, overseas markets. And that's a little bit different kind of public corporation, but they do report their numbers, and that allows me to kind of put together a picture of the entire industry. So send me an email, and I'd be pleased to add you to the list.
All right, John D. McCowan. All right, well, that's great. Thank you. Really appreciate that, John. That brings us up on the end of our show. A couple of call outs this week on the Freightvine podcast. Chris Kaplis is talking to Keith Brandis. He's a VP over at Volvo Trucks, talking about their approach to decarbonisation and battery electric vehicles, along with some of the challenges they're facing as they head towards near zero emission market requirements. Don't forget, DATCon is coming up in Kansas City, October 22 to 24. Pre-registration, early bird registration ends July 4. Go to dat.com/DATCon. On next week's show, we have owner-operator Tyler Jones giving us a closer look at how small carriers are using the spot market, especially in this rather difficult market as rates continue to bounce along the bottom. And with that, it's another show in the books. Be safe, everyone. Stay cool during this week's record-breaking heat dome, which sits over large parts of the US, particularly the Great Lakes and Northeast regions where John and I are located. Check in on your neighbours, make sure they're okay during the heat, and we'll see you next week at 10 a.m. Eastern, 7 a.m. Pacific.